Hello and welcome to AI Market News by LM. Today, we're digging into some pretty serious market tremors, where just a handful of policy posts managed to rattle all of Wall Street. So, here's what we've got on tap. We're going to start with a quick market snapshot to see where things landed. Then we'll dive into the geopolitical shockwaves that really caused all the chaos. After that, we'll put a couple of key sectors under the microscope, try to get a read on the overall market mood, and finally, we'll look ahead to what's coming up next on the calendar.
All right, let's jump right in and take a look at the closing bell numbers.
You know, the mood on the floor today was, well, you could feel the optimism just drain out of the room. We actually kicked off the day pretty strong, hitting a new intraday high. But that good feeling didn't last long, as a string of pretty surprising announcements started to roll in, triggering a sell-off late in the day for some of the biggest names. And this slide really tells the story, doesn't it? We saw a real split. The S&P 500 ended up down about 1/3%. But look at the Dow. It dropped almost a full percentage point. And then there's the NASDAQ, the tech-heavy index, which somehow managed to buck the trend and finished in the green. It was a really mixed bag out there.
Now, if we broaden our view a bit, things were a lot calmer elsewhere. The currency markets were pretty quiet. US USD was basically flat. Over in commodities, crude oil edged up a little. But what's really interesting is gold. You'd think with all this uncertainty, investors would rush to a safe haven like gold, right? But it actually dipped a bit, which tells us investors were reacting to very specific news, not just running for the hills.
So, what was the big deal today? To really understand the market's wild ride, we have to look at the why. And today, the why was a sudden flurry of presidential announcements that seemed to catch Wall Street completely flat-footed.
And they came fast and furious. First, a bombshell plan for the U.S. to control future sales of Venezuelan oil. Then, a direct shot at defense contractors, telling them to halt dividends and buybacks. After that, a proposal to ban big institutional investors from buying up single-family homes. And, as if that wasn't enough, some fresh, sharp criticism aimed at the NATO alliance.
And you know, it's not just what was said, but how it was said. This direct quote from the president's social media really highlights the kind of stark rhetoric that just injects a whole new level of geopolitical uncertainty into the mix, giving investors yet another major risk to worry about.
Okay, so we've got the announcements. How did all of this actually translate into dollars and cents in the market? Let's connect the dots and look at the sectors that were right in the line of fire.
I mean, the cause and effect here could not be more obvious. On one side, you have that threat to halt shareholder payouts. What happens? Boom. Shares of defense giants like Lockheed Martin and Northrop Grumman just plummeted. On the other side, you announce a plan to ban big money from the housing market, and, well, the S&P home building index drops nearly 2.6%. It's a textbook example of just how quickly policy can hit the bottom line.
So, beyond these specific sectors that got hit hard, what was the overall vibe in the market? What was the mood? To figure that out, we can turn to some really cool indicators that help us read the room. First up is one of my favorites, the Fear and Greed Index. It's basically the market's mood ring. It looks at 7 different indicators, things like market momentum and volatility, and boils it all down to a single score that tells us if investors are feeling fearful or greedy. And no big surprise here, the needle has swung squarely into the fear zone. This tells us that all those geopolitical rumblings and policy curveballs have definitely made investors a lot more cautious. And that makes perfect sense, right? When policy becomes unpredictable, it's incredibly hard to price risk, which makes people want to pull back a bit. Another crucial tool we need to look at is the CME FedWatch tool. Now, this one isn't about emotion. It's all about expectations. It's like reading the tea leaves of the market, analyzing futures pricing to tell us what traders are betting the Federal Reserve will do next with interest rates. Given all this new uncertainty, watching how these probabilities shift is going to be absolutely critical.
So, with all this policy-driven drama as the backdrop, the market is starving for its next big signal. Let's pivot and see what's on the horizon in terms of economic data that everyone's going to be watching like a hawk.
Looking at the upcoming economic calendar from investing.com, we've got a big batch of data dropping tomorrow morning at 8:30 a.m. Eastern. Now, all of these are important, but the one we'll all be glued to is initial jobless claims. That's our freshest snapshot of the labor market. The big question now is whether the fundamental strength of the economy is enough to act as a buffer against this rising tide of political uncertainty.
And that's our deep dive for today. Before we sign off though, we have a quick and very important disclaimer. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks so much for watching. If you found this breakdown helpful, please don't forget to hit that like button and subscribe for more AI-powered market insights.